bring this meeting to order. We'll start with the Pledge of Allegiance and roll call.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you very much.
We got a roll call, please. Commissioner Blaney?
That's all we want.
Present. Commissioner Good?
Present.
Commissioner Biggs?
Here.
Councilman Witten?
I am here.
Councilman Graham?
Here.
Councilman Jensen?
Here.
Councilman Larson?
Here.
Councilman Paparad?
Present.
Councilman Rivas?
That's who's missing.
Councilman Sims?
Present.
And advisory, Nestle?
Here.
Okay. Yep. Approval of minutes.
Make a motion to approve. Second.
Okay, I have a motion and a second. All those in favor, signify by saying aye.
Aye.
Opposed, same sign. Motion carries. All right, and we'll move on to the Capital Cities presentation, okay?
Hello, is this working?
Yes.
Okay, great. Hello, everyone. Thank you for having me. My name's Amanda Black, and I'm with Capital Cities. We're the outside investment advisor to the foundation. So what I'm going to briefly cover today is the first quarter report, including a very brief review of the markets. I'll update you on your portfolio, the performance, and then I will cover a brief fee study where we outline all of the different fees that you pay and benchmark those accordingly. So we're going to start by just looking at page 1 of the report. It's also what you see up on the projector. This is the market review for the first quarter. So today we're talking about the period ending March 31st, 2019. I'm happy to say that we have better news to report this time around than last time I saw you all in February. The markets were a lot friendlier to us in the first quarter, and really that was driven by investor sentiment surrounding the Fed. So the Fed took a pause, so to speak, in their tightening monetary policy. So rather than continuing to raise rates or interest rates, the Fed has actually paused a bit going into 2019, and now the expectations are that they will not raise rates in 2019. There may even be an interest rate cut ahead, and that was viewed very favorably by the markets. Equity markets performed very well in that scenario, and you can see the blue bars on that chart represent different styles of equity markets, both in the U.S., which is on the left side of the page, and then the non-U.S. markets on the far right. So you can see equity markets were up over double-digit returns there, bringing the one-year numbers, which are the gray bars, into positive territory. Within non-U.S. markets, again at the far right of the page, we're still seeing negative returns on a 12-month basis. At the bottom of the chart, we see fixed income returns, and fixed income also had a nice quarter, not nearly as high as equity, but that wouldn't be expected anyway. So we saw nice returns across the broad fixed income market. Riskier sectors of fixed income did even better, kind of following suit with equities, with high yield up over 7% for the quarter. Similar story, though, non-U.S. fixed income markets are still negative for the one-year period. So we're still seeing some of that fallout from the global trade concerns and the negotiations that have been occurring between the U.S. and China and other countries. That's still hurting foreign markets a little bit. Let's take a second here and focus on your portfolio. So on page 2, we'll look at the very top of the page just for a second. This is where we make sure that your actual asset allocation is in line with the allocation outlined in the investment policy statement. So it is, indeed, you can see the pie chart on the left is nearly identical to the pie chart on the right, so you're in line with your target. Down in the middle of the page, you ended the quarter with a market value of $160 million, $379,353. So that represents for the quarter, in that chart on the right, a 6.5% return for the quarter. So really strong return for the first quarter, and that brings the last 12-month return to 4.0%. So I do want to give you an updated market value just as of yesterday. if you've been watching the markets, you've seen up and down markets, very volatile. I'm very happy to report that despite some negative returns across the broad market, your portfolio is just ever so slightly positive for the last few weeks. It's up to $160,696,591. So that represents like a 0.2% return, albeit positive. Okay, so we don't have any changes to the stoplight grid at the bottom, so I'm not going to cover that. But I do want to detail your performance a little more because we now have a 3-year performance number under our belt. So let's look at page 4. So I want to first point you to the bottom of page 4. There's a chart that is titled Calendar Year Performance. And what this shows you, and we don't always look at this, but now that we have 3 years, I think it's kind of interesting to see where we've been over these 3 years. And the thing I really want to point out is if you look at 2017, you can see that the Porter County portfolio was up 11% in 2017. However, that ranked you at the very bottom of the peer group of other foundations. Now, I want to mention that to you because of your asset allocation. So you have a 40% allocation to stocks. The average allocation to stocks across foundations across the country is more like 60%. So when you have equity market returns like we did in 2017, when stocks are up between 13 and 18%, that's why an 11% return kind of put you at the bottom of the peer group. However, conversely, I think it's really important to show you 2018, where you had your peers, so other foundations, were down anywhere between about 2.5% and almost 7%. You were only down 2.8% during that time, and that actually put you at the very top of your peer group. And that's why I just want to remind you, that's why we're adhering to this asset allocation that's more conservative than peers. So then when you kind of combine all of that, I want to point you to the number at the top. Now I'm looking at the top chart, the very far right number. It's the since inception number. So this is your 3-year performance number. You have had an average annual return now of 6.35%. That is outpacing your custom benchmark, so your passive benchmark. It's also outpacing your performance target of 5% per year. So I think it's just really important, again, to note that we're not trying to earn the highest return possible. We're trying to hit that 5% return with as least risk as possible, and that's what we've done. So finally, on page 6, to kind of bring it all together here, so I said that you've had a 6.35% average annual return over a 3-year basis. So when you compound that over that time period, you can see on the chart there on page 6 that you've had a cumulative return of 20.3% now in this portfolio, and that 20% return translates to $27 million in gains to the foundation. So I'll pause there. Any questions on performance?
I know last time I asked you about international equities, and we were looking at that before. Is there any opportunity for us to reduce some of our exposure there? I know we're at 10%, and that's what we were at before. Is there any thought on, because that has been a troublesome market.
It has been a troublesome market. So the question is whether international equity is something that we should consider reducing. The thing with that, what we've done here is with your, let me get you the right number here. Your international equity, bear with me so I can speak to this correctly. Yep, and you said it. It's 10% of the portfolio. Your U.S. equity is 30%. So the international component of total equity is 25%. That is demonstrating what we call home country bias. That means you have far more weight to U.S. equities than you have to non-U.S. If you were to have a market-neutral weight to non-U.S. equities, it would actually be closer to 50%. And what I mean by that is if you were to take all of the stocks outstanding in the globe, about half of them are outside of the U.S. So a lot of institutions just match that with their portfolio. This group has made the strategic decision to drastically underweight that. So yes, you still have some international exposure, but we think it's just enough to give you some diversification. And we're very comfortable with that 10%, especially over the long haul.
What does international mean? Asian, Europe, South America? Africa, China?
Yes, not so much Africa. That's more of a frontier market. India is more of a frontier market. So you've got developed, then you've got emerging, then you've got frontier. Your portfolio in the international space is primarily developed. So that's Europe and Japan primarily. Okay. Any other questions on performance?
Yeah, just in talking about our policy that we have in place, obviously everything goes back to that, but I guess with the forward-looking guidance that interest rates are not going to be moving, at least in the next year or two. I mean, I don't know what the Fed's doing, but it just seems like it's going to be a long slug to get for interest rate growth that then makes the bond markets look a little bit more inviting. With that being said, in the current situation that we're in, do you feel we're still chugging? I mean, I also look at the stock market and the volatility. There's just really nowhere else to sort of go right now. So I just wanted to get your comments on that a little bit. I know don't want to put you in a stick bag or anything.
No, that's a great question. So if you would look at page 2, you can see at the top, the pie chart on the right, you have 58% in fixed income or bonds. That is a lot of your portfolio in bonds. Bonds are not a sleep-at-night asset class anymore. However, you have to have something to provide a ballast versus the equity exposure that you have. And it was this board's desire to not move into things like hedge funds and private equity and things like that. So outside of equity, then our choice is bonds. But let me show you something with that allocation. So it's 58% of your portfolio, but look at the chart on the left. Look at how many slices we have it divided into. All of those are active fixed income managers who are doing something slightly differently from one another. Everything from low duration styles where they're just focusing on the shorter part of the maturity spectrum and high quality, to things like the Western Unconstrained and the Luna Strategic Alpha portfolio. Those are go-anywhere fixed income funds that have a little bit of emerging markets, a little bit of non-dollar, a little bit of high yield. So those are going to do better when interest rates are static. And then you've got things like the BlackRock Total Return, the Dodge and Cox Fund, and those are more of your just traditional broad fixed income funds. So we don't take that allocation lightly. We know that you have to be pretty creative and diversified, and we're pretty happy with that mix. Every single one of those managers over that 3-year period is beating their benchmark. That's part of the analysis that I looked at before coming up here today.
Thank you.
Anybody else have any questions? Either of you two? Comments?
Okay, let me cover the fee study then for you quickly. It's behind tab 2 on your hard copy, and then Treasurer Clancy is going to pull up the projector version of it. So just to kind of remind you, as an institutional investor, which you are, you pay 3 different types of fees. Really, every institutional investor does. You're paying for investment management, you're paying for advisory services, and you're paying for custody or safekeeping of the assets. The way that you have this structured is that you've hired different entities to fulfill each of those roles. Accordingly, that allows us to report the fees to you very transparently for each of those underlying components, and we also are able to benchmark those. So we do that formally on an annual basis, and that's what this document serves to accomplish. So let's look first at the investment management fees on page 3. So just broadly speaking, we want your overall fees to be low, but we recognize that to have some active management in the portfolio, like with the fixed income we just talked about, you will have to pay some fees. We try to balance that with passive management, which is really low cost. We also want to make sure that you have the least expensive share class or the least expensive version of every mutual fund that you use. We don't just wait for this fee study to move you to the least expensive share class if a new one comes out, and you've seen us do that along the way. And then we want to benchmark all of these funds compared to other funds who are doing similar things and make sure we're paying fairly. So on page 4, we show you the different equity funds. We list every one of your funds. We show you what the style is. We provide their fee schedule and basis points. So for instance, 100 basis points is 1%. And then we show you peer group fees. So the easiest thing to do here is to look at the bold fee schedule for your managers and then look at the bolded column, the median of the peer group. And you can see that every one of your managers is solidly below its respective peer group. Your passive fees are extremely low. Your Schwab S&P 500 is 2 basis points, and the Vanguard International Index is 6 basis points. On fixed income, which is page 5, we do the same thing. We're utilizing different styles of fixed income, so there are different peer group medians. But still, once again, all of your managers are solidly below the peer group. On page 6, we move on to the custodian. So you all use Charles Schwab as your custodian. If you look at the fee schedule in the box on the bottom left, you can see that Schwab charges 0 basis points on the assets, so that's hard to beat. That's not a rounding error, that's 0. The only way Schwab gets paid is if there are mutual fund trade fees. So not transaction fees within your funds, but if, for instance, we need to help you create cash and we have to sell one of your funds, then that's a $20 trade fee. So kind of the downside of this is that you don't have somebody local who's kind of walking you through your custody arrangement. Schwab is more of an online bank. But we felt like that was appropriate because Capital Cities really helps to facilitate all of that for you, so we're able to keep costs really low. Page 7, we talk about Capital Cities fees. I just want to remind you that we are also a fiduciary of these assets, just as you are, so we take this very seriously. Our flat fee is $65,000 charged annually, or charged quarterly, but that's an annual fee. We have no affiliations with any investment managers, brokers, banks, or anything like that, so we're able to avoid conflicts of interest and serve as your advocate. And I'll kind of leave it to you to assess our work, but we think that that's fair.
And that's the same amount it's been every year.
Yeah, we don't change that.
Yep.
We're not very good at raising fees. On page 8, then we bring all of this together because we think it's really important that you as stewards of these assets can report to your constituents exactly what you're paying and that it's fair. So like other institutional investors, the bulk of the fees is the investment management expense, and that's very normal. So you're paying a weighted average fee of 44 basis points for that.
Can I ask a question on
Sure.
that? What is that figured?
So that takes every one of your
I
mutual
know,
funds.
but when is it figured per month?
When is it figured per month?
Yeah.
So that's an annual, that's a 12-month view.
So when is it,
So we use the 331 market value as
so
the
whatever it is,
denominator.
331, we pay 44 points?
Yes.
Okay. So it's one time a year?
Well, it's always netted out of your performance. So mutual fund fees, so for
What
instance,
are the mutual fund fees figured
when are they figured?
in a month? Because my sources tell me that it's figured on the highest daily balance in that month. It's not the 10th, the 15th, or the 20th. They track it all month. The highest day that you had a balance, that's when the fee is charged.
Well, what if you sold out of it the day before?
Doesn't matter. They look at the highest balance for that month, regardless of the day, and that's when the fee is charged.
So the fees that we're reporting on pages 4 and 5 are the annual fees. So if we look at all of the dollars...
If Schwab uses a mutual fund, the mutual fund charges a fee. Correct?
When Schwab uses a mutual fund?
If Schwab put our money in a mutual fund, the mutual fund charges a fee.
Correct.
That balance, that fee is charged on the highest balance in that month, is what my people tell me. Is that accurate?
I don't want to state that you're wrong without more facts, so
Okay.
I would have to double-check that.
Okay.
That seems
Why don't
unusual to
You
me.
just email me that when you get it.
Yeah, I'm happy to
Sure.
follow up. But what I do know for certain is that the fees we're reporting on pages 4 and 5 are your annual fees. So if you look at your average balance, for instance, on page 4, the Schwab S&P 500 index is 2 basis points, and you have $16 million in that fund. If you looked at that fund over the course of a year, your fees should be 2 basis points.
On March 31st?
But, that's always changing. So in order to give you an idea of exactly what your weighted average fee is, we had to pick a number as the denominator. So we chose 331 for the weighting, because from time to time, that Schwab fund might be this much of the portfolio or this much. So we had to take some liberties with the calculation.
That's fine.
Okay, and that's the industry standard for how you do that.
I've heard that before, too.
Okay. So the investment management fees are 44 basis points, which is really low, and we've told you that they're all below their respective peers. Custody fees are $400 a year, which averages out to zero. That time it is a rounding error, but that is $400. And that could change. If there are less fees or more fees, that'll slightly change. $65,000 for the consulting fees is 4 basis points. So your total fees, trying to come up with a snapshot for a 12-month period, are 48 basis points. The rule of thumb used to be below 1.5%, 150 basis points. Now it's more like, you're more likely to hear that you should be below 1%. So I feel pretty comfortable showing you a fee that's below 0.5% for all of these assets.
Do you have some comparisons?
What's that?
Do you have some comparisons with other groups like
Yeah.
ours?
There are really no comparisons for foundations, and I'll tell you why. It's because nobody is this transparent in reporting their fees.
Okay.
It's easy to look at investment management. There's no database that I know of that shows consulting fees.
We really like the pat on the back about the transparency.
Well, custody fees, we work with all different types of clients. For instance, clients of ours that use Northern Trust, Bank of New York Mellon, Wells Fargo, they're charging anywhere from 2.5 to 5 basis points on the total assets, and that would add up quickly on a portfolio as big as yours. So zero there, like I said, you can't beat that. But unfortunately, there's just not a great peer group of foundations out there who are reporting fees in this manner.
Okay.
And let me just interject, as somebody who actually does this as well, I can tell you that this is competitive.
Okay, thank you.
For the record.
Thank
Thank
for
you.
that.
Thank you.
Thank
So
you.
we wanted to hear from this end of the room.
That's why they're here.
And I do want to make sure I answer your questions correctly, but I'll have to follow up with the mechanics of that.
Does anybody else have any other questions about this? I think less than 0.5%.
That's awesome.
Pretty great.
That's what I had for you all today, but happy to answer anything else.
Nice presentation.
It is.
Thank you. We're not going broke.
What do you see coming up here?
Oh, thank
Hold
you.
you to it.
Projections.
Watch how you wait.
Well, I'm not going to talk about the market. I'll tell you about the projects we'll do for you. At the next meeting, that's when we typically would look at your asset allocation. I really don't foresee advocating for any wholesale changes. However, that's a good time to refresh the international exposure, to talk about the fixed income environment. We'll remind you what the return expectation is for your portfolio, and we'll make sure that that's still feasible given your 5% return target with kind of decreasing return expectations. So we'll talk about all of that and document that and determine if there are any changes necessary. After that, we would then update your investment policy statement with any housekeeping changes or bigger changes if need be.
And a follow-up with my bond question, and
Yeah.
it may be in here, I just haven't seen it. If you took our portfolio since inception, would you be able to break out what we've made from a return from the equities versus the bond portfolios and everything, just to show
Sure.
what the two are performing at since inception?
Yep, you're right, that's not in here, but we absolutely have that data.
I think that would be
Yep.
interesting information to have for the next
Yep.
meeting, so,
Yeah, we'll run that for you, and we'll bring that'll be a good thing to add to that portfolio construction discussion anyway.
So while we're talking about the next meeting, let's set the date.
Okay.
So our second quarter is doing strongly as well? Is that what you said?
Not strongly, just positive, where if you look at a list of market indices, the S&P 500 is up, but almost everything else is slightly negative or worse for the second quarter
Oh,
to
that's
date.
a big point, too.
But your portfolio is slightly positive.
so it's 2 out of 3 months, basically.
Yeah, that's true, it is now.
So we still got 30
We still have a
days.
month and 45 days.
So
Oh, my God.
3 months from now would be third week in August? Yeah, when do you guys meet, the last week in August?
Yeah, the fourth Tuesday?
Does the 27th work, August 27th?
Yeah, that works for me.
Works for me. Easy to
Good.
get on
Does that
now.
work for you?
Yeah.
Yeah, I'm actually going to add it right here while I'm sitting here.
I guess I better actually check.
Oh, actually, it was already in there. So August 27th.
So August 27th at 5 p.m.
Great.
And we'll be talking about asset allocation in addition to our usual report.
That should be a
All right. Any other questions or comments? Thank you.
Okay, thank you all.
Thank you.
Appreciate it.
Thanks, Amanda.
Have a safe trip.
Be careful.
Sorry about the water. Good thing you
For
live.
Bambi.
Oh, don't worry about it. Yeah. Okay, we've got the attorney's report up next.
I have nothing.
All right, I just wanted to briefly state, are you sure? He's been talking all day. We had a meeting, we've all been discussing the charitable giving aspect of this. And so myself and these two guys, well, the four of us met. We've got the council president and the commission president and the vice president and chair of this board, and just talked about how do we get it rolling, what do we need to figure out to get this ball rolling, what information do we need. One of the things we talked about was where are we at exactly after last year's bad year with our rainy day fund, that we have a resolution to fill before we start handing out any money. And I think we're all a little bit surprised and disappointed to realize we have $3.9 million in that right now. And our resolution talks about 3 years of our budgeted amount, and we budget about 4.7. So, if we're getting 5% of 160 million, our mercury level's not going to go up real fast, so we're looking at a few more years before we can get to this. That being said, we still think it's time to put together a process, and we've had some just very preliminary discussions, and we want to hear from the rest of the board. So I've heard from Bob, he's got some good ideas, and want to hear from everybody else and talk about what kind of an amount we're thinking of distributing and all of those kind of things. So please be brainstorming. Please call any of the four of us. And meanwhile, I wanted to point out that as far as charitable giving goes, we are currently giving away $1.1 million. OE gets $50,000 every year. The Family and Youth Services Bureau gets $600,000 a year, and the Council on Aging gets $450,000 a year. And that comes from, that's budgeted in the foundation's budget. So we are doing something while we're trying to figure out how to do some more. So other things in our budget, in case anyone doesn't remember, is the jail medical, the health, and we've got some health insurance coming out of there, 911 So these are big ticket items that are budgeted. And so it was a really good thing we had the rainy day fund.
You're right.
Because last year, the entire budget came out of the rainy day fund. So without that, I mean, these are things we have to pay for. So it's a good thing we did that.
Now, the question on the 3.9, is that through December 31st, or does that include the first quarter?
I think that's what we have right now, right?
That first quarter should have reduced it pretty significantly.
No.
Because we have to get to the end of the
It
year.
doesn't work that way.
We came up with a date certain, and it was once we know how that year ended, on a date certain at the beginning of the next year, that's when we juiced the pot.
Yeah, once a year. So it's not
And
going
there
up and down.
there
all
wasn't
year.
any.
Right.
Yeah.
And statutorily, it's 5% for the year.
Yeah.
So we had to know,
You can't
we don't
do it
do it
quarterly.
quarterly. But I have high hopes for this year, real high hopes. So, and that's why, and listen, we created the rainy day fund realizing that we were going to have years like last year.
Yep.
We knew that.
That's why we did it.
We talked about it ad nauseum. We wanted to be able to get to those dips in the road and, and not have to worry about being able to cover our expenses. So last year was a good example of that. But luckily, not every year is like that. And if you average out since the inception of this thing, we've made a lot of money for the residents of Porter County, a lot of money. And when you couch that against before the foundation, it was less than 1% in years. We just weren't making very much.
Well, look at all the projects we do.
Yeah, and on top of all the
money is covered.
So it's been a huge benefit to the taxpayers, but we understood that we were going to have some dips and turns in the road, which is why I think that we philosophically decided to have 3 years of our foundation budget built up to get us through those rough patches. But I think it's one time a year, and that was how it ended up.
I'd like to also point out on top of that, Dan, is that, we're, in the beginning of Amanda's presentation, we're back to the original $160 million that the county got when they sold the hospital 11 years ago. And we've used that money over the last 10, 11, 12 years to help shore certain things up and to get through every year. And it's very encouraging to know that 12 years later, we're back to the original corpus to start moving forward on. So I think that's a real positive thing too, that the endowment is getting bigger, and I think that's something that is a nice.
It's probably worth a plaque.
Yeah.
Bob wants a plaque real bad.
Yeah. So I just wanted to point that out.
So look away, Scott.
To put it in the budget.
I told you I'd pay for it. That's all right.
Anybody else?
If there's a dip in the road, Dan, I think the highway department.
Can fix it.
Yeah, we got the highway department.
Just pull some money out of
I know,
And
it's
put the dip in the road.
All right.
I'll make a motion to adjourn. Second.
All those in favor?
Aye.
Meeting's.
Seeing you.